Hello and welcome to this Markets Today special. I'm Udayan Mukherjee. With me is my guest of the show today, Rahul Singh, Chief Investment Officer of Tata Asset Management Company. Rahul, great to see you on the show. I want to start by asking you about the new bit of concern which has come about for the markets over the last 1 week, which is that we may not have a normal monsoon. I mean, there's talk of El Nino once again. Does it change a lot in terms of your assessment of how the market will do this year?
Well, I think it's important to figure out what's going to happen to rural consumption. So, in that sense, what we have seen in 2022 was that urban consumption has been extremely strong, and now that urban consumption was slowing down or is definitely slowing down, there were hopes and there were expectation that rural economy, which was not doing well in 2022, would start to do better. So to that extent, this can be a dampener because we've had a couple of 2, 3 bad years for the rural economy, starting with GST, demonetization, COVID, etc. So this was probably going to be a first normal year after a couple of 2 or 3 bad years. So to that extent, this is definitely a dampener. I won't think, beyond that, we look at it from a very broad brush perspective because each consumer company is different. Each leg of consumption is very, very different. And finally, the lines between urban economy and rural economy have also kind of thinned and merged. So we have to be careful in painting this with a very broad brush. But yes, to answer your question, yes, it definitely changes things at the margin.
So let me ask you a few more granular questions about the whole consumption piece. Let's start from the top, the ones which are not seen as rural focused but are very expensive. They've been underperforming over the last few quarters. The names, the expensive ones like Asian Paints and Pidilite and Havells. Do you see further room for compression of their multiples, or have they compressed enough?
So let me take a step back and let's try and understand what are the things happening. I mean, there are two big trends happening in the market today. One is that obviously we are no longer in a low interest rate environment and easy liquidity environment, which had led to these valuations going up much more than the earnings growth rate. The stock prices went up much more than the earnings growth rate. So there is a valuation discipline coming back into the market. Let me just reemphasize that word, valuation discipline. It doesn't mean that every expensive stock is doing badly, but discipline is definitely coming back. And the second thing which is happening is that we are seeing a revival in the cyclical parts of the economy, which is credit growth, investment cycle, real estate, manufacturing. So, ultimately, it's a zero-sum game. One of the reasons why some of these stocks or sectors became expensive was, apart from low interest rates, was also because there were lack of alternatives, because the cyclical part of the economy was not doing well. Now that that part of the economy has also started firing after, almost a lost decade, we are seeing a dual impact on the, let's say, the defensive, high quality, high growth, high P kind of stocks, which are coming under pressure from both aspects, high interest rates, as well as the alternatives which are now available in the market to really generate alpha.
No, fair point. But has this trade played itself out mostly, or do you think there is more to go?
Oh, I think it can be a beginning of a fairly long period of time correction or valuation discipline to keep coming back and hurting some of these stocks, especially the stocks or companies which are not able to keep pace with the earning expectations which are out there. In some of these cases is still very high. The growth expectations can still be very high. So any minor disappointments pre 2021 used to go unnoticed if it was a high quality, high growth stock. Not anymore. So I think the room for error has reduced, and the margin of safety, which was never there, but margin of safety today gets punished if you're not able to keep pace with growth. So look, India is a growth market, so growth will always get some premium. Let's not make any mistake about it. And we also look for growth when we invest. But if the valuations have gone much beyond the growth expectations, or if quality has got a premium which cannot be justified mathematically beyond a point, I think that process can go on for a fair bit long. Remember that the reverse has happened over the last 7-10 years, and right now we are only 1 year into this process of what I call as valuation discipline coming back into the market, and we could just be beginning in the beginning of that process.
What about the more rural focused part of the consumption basket? The names like Relaxo and, the Daburs of the world. Would you be more circumspect given what you just said about the monsoons for the next few quarters?
Yes, I think in the rural economy, as I mentioned, at the margin, the monsoon news flow is not great news for sure. So one will have to evaluate these the rural economy leveraged companies or companies which are too dependent on rural economy to fire. We'll have to look at it from that angle. But look, I think we've had these warnings. This is still very, very early in the process of trying to call out monsoons. As you know, with monsoons in India, I think the average numbers also can be high and the spatial distribution can be bad. So, it's very, very difficult in a country like India to generalize and paint with a very broad brush. So we will have to take company specific calls, frankly, because even in consumer companies, there are companies which have been hit not only by top line slowdown but also due to margin pressure. In some cases, the margin pressure today may not be as bad as it was last 1 or 2 years. So really, for consumption as a theme, it is becoming extremely stock specific, bottom up kind of a market. We are no longer trying to play consumption as a theme because there are multiple things happening in the economy today. Interest rates, input costs, rural economy in terms of the monsoons, etc. So it becomes a very bottom-up market, and not just for consumption. This is in general true for the markets per se, but more for consumption today.
What you said about valuations compressing, valuation discipline coming back, if you were to extrapolate that question to the broader market, would you say India's challenge today is more earnings related or more valuation related, given that we've seen some semblance of correction over the last few weeks?
Yes, that's a very good question. I think the problem today, or the let's say the process today, which we are going through, is seems more like a valuation problem. As far as the earnings growth rate is concerned, the composition might change. So we might have banks and capital goods and industrials doing better. Consumption may not be doing so well. IT might just hold on. Pharma may not be that good. So overall, it could be a trajectory which could be, it could be either 12% growth rate or 15-16% growth rate. We are talking in that kind of range. As far as valuations are concerned, till a few months back or till 2-3 months back, we were at pretty higher end of the valuation premium to other emerging markets. Our valuation premium to other emerging markets had reached 85 to 90%, if I'm not mistaken, in the month of November, December. Now that's down to 65% today, thanks to other markets doing well and to small correction which we have had, and time-based correction as well as the small correction we have. So we are now at a 65% valuation premium to the MSCI Emerging Market Index, which is not the same as what we have traded in the last 10 years, which has been in the range of 45-50%. So you can argue we are still a little bit on the higher side, but the excess which was there in November, December of 85-90% premium, that excess is definitely gone. And from here on, obviously, earnings become important, and also how the other markets do become important. So let's not forget that one of the reasons why this valuation premium went up to the high levels of 80-90% is also because China did not do well. Other emerging markets, which are more linked to the US and European markets, declined much, much more, and India held steady. So all we had to do was hold steady, and our premium kept on expanding. And therefore, what happens to this premium is not just a function of our earnings growth rate. It's also a function of what happens in China, how quick is their unlocking, and how much more money goes there. Those are the questions which I think will drive that premium. As far as absolute valuations are concerned, we are coming to reasonable level now. I mean, if you look at fiscal 24 earnings, we will now be trading at 17 and a half times P. This I'm talking about Nifty 50. So, give or take 5%, we are there. We are there at a fair valuation. So from here on, the confidence level is a little higher that at least our, equity returns should be um, tracking the earnings growth rate and not really lagging the earnings growth rate, which was the case in November, December.
This question about the equity returns rate, Rahul, so far domestic investors have been remarkably patient, but they've gone through 1 year where equity returns actually did not beat fixed income by any significant margin in most portfolios. This year, again, fixed deposits and fixed income returns promise to be quite solid, and the equity return is uncertain. Markets remain volatile. Do you think might be a point this year where the patience of domestic investors begins to thin out a little bit?
We could see a little bit of that. There's no doubt, and also we have also been advising investors and our partners to pay more attention to asset allocation because at some stage in the last 3 to 4 years, some of the asset allocation might have become a little bit lopsided towards equity. So this is a year to again start focusing on asset allocation between debt and equity and other assets, etc. Clearly, there is no doubt about it. And this is what we've been advising. And there are some products which we have which specifically help you do that, even if you can't do it yourself. So I think those products are getting huge acceptance. We are still seeing flows in that. As far as the returns are concerned, this is a consolidation phase. You can argue, this was probably overdue, given what we went through in 2021, not only in India but as a world in terms of what equity returns we got. So I think I would actually see it positively and say that this is a good time to get this consolidation in instead of creating a bubble and then getting a sharp correction. Because what's happening in Indian economy at one level is also quite positive that we are moving from consumption-driven growth to more investment-driven growth. And once that happens, markets broaden, your economic growth rate sustainability is much better. Nothing to compare to what happened in 2003 to 2008, which was led by global growth as well. But even if we can sustain 6% GDP growth rate, it's not going to happen with only consumption. Investment has to kick in, and I think that, thankfully, for a variety of reasons, seems to be happening now. So, ironically, it's making us more positive as fund managers from a 3 to 5 year period. Even though from a 1 year period, we know that this valuation discipline and consolidation could continue, but it's not a bad time to keep investing. So as I keep telling everyone that this is the year to manage your risks, not to be totally out of equity markets.
Fair enough. You know, I must ask you about what has been happening over the last few weeks with this Adani episode, Rahul, as well. As a fund manager at Tata AMC, did you ever own any of the group companies? Because, looking through the mutual fund portfolios across asset management houses, it seems curious that barring the odd Adani ports, most mutual funds didn't own a very significant slice of that group. Did you?
Yes, that's correct. That's true for us also, and I think some of it is to do with our investment philosophy of not buying things which are very expensive and the valuations which cannot be justified, and not just true for this group, but in general, I'm saying. So you're right that even in our case, uh, we have exposure to ports and cement companies, but not to the other group companies. You're right.
The case of the cement companies is curious, Rahul, because till last year they were independent, strong companies in their own right, and these stocks have taken such a knock, ACC Ambuja, because of the connection with that group. Did that throw up any opportunities for you? I mean, would you look at these cement companies independently of what's happening with the group?
So we've been actually owning these companies even before they became part of the group. I think there is an opportunity in cement for consolidation. Also, if you look at cement as a sector is a sector which almost becomes a proxy to infrastructure and the capex phase which we are entering into. They became let's say, because there is a cliff there in terms of the quality of companies which is available in the construction space or the infrastructure space. We don't have as much choice today in the market as we had in 2003, 4, 5 period. So clearly, cement becomes a good proxy for infrastructure, cement as a sector. And we own cement sector across our portfolios, a lot of stocks. I mean, we just not the stocks which you mentioned. So clearly, as a sector, we like it because we are positive on capex cycle and investment cycle picking up. And cement is a very safe way to play it, if I can put it that way. Instead of buying the higher beta names, till we get more conviction on the more higher beta part of the infrastructure and the capex cycle.
Speaking of this capex cycle, Rahul, what's the best way to play it at this point in time? Because we haven't had a major revival, visible revival in private capex yet, but already the capital good kind of companies have become very expensive in terms of P multiples at least, or conserve, or any kind of valuation metric that you can look at, which is conventional. Do you have conviction enough to buy those names, or are you playing it differently?
So it's very interesting that because this sector has not done well in the last entire decade almost, we are actually looking at most of the companies and most of the industrial or manufacturing or capital goods companies which are not there in the large cap space, mostly there in the mid and small cap space. So the choice available is there, not so much visible in the indices or the large cap space, and more visible in the small cap space. So that's where I think the action is, and that's where I think the business momentum is. Most of these small companies, which are good managements, good technical capabilities, have always been around, but now are benefiting from either the domestic capex revival, and I would disagree with you there that there is no domestic capex revival. Yes, of course, like 2006-7, there are no mega power projects, so there are no mega infrastructure projects being announced, which are coming on the headline in the headlines of newspapers. But clearly, there is a plenty of granular capex happening today across various sectors and various companies, which is helping us. Also, on the export side, there is a renewed interest in Indian manufacturing becoming the next outsourcing hub. And it is not it's becoming reality. I mean, the more we speak to companies, and these we are talking of smaller companies here, not very large companies also. Every company is now seeing a renewed interest in exports, in the exports market, where they were taking 1 or 2 years to get approval. They are getting approvals in 6 months. Similarly, if you look at the MNC companies which you mentioned, which are, I agree with you, have gone up and are trading at expensive valuations. But if you look at their activity and their actions also, they are putting money into India to set up new manufacturing capacities for their global businesses. We've not seen that. We've only heard them talk about it, but we've never seen them actually do it. Now it's actually happening. So whatever the tailwinds might be, whether it's geopolitical or China plus one or whatever be the reasons, it's actually becoming a reality today. So there are opportunities. There are opportunities in the smaller and mid-sized companies more than there are opportunities in the large companies, like you mentioned.
Okay, Rahul, thank you very much for your time today. Been great talking to you. Thank you.
Thank you, Udayan. Thank you.
If you like the video, do like, comment, share and subscribe.